I'm Paul Coles. I'm a board member at ITFA and chair of the Market Practice Committee, and just going to talk a little bit about credit risk mitigation and why institutions originating risk will typically look at these different risks, which ones they are, and find ways to mitigate or reduce them. So the typical ones are credit risk. That's the biggest one. That's the risk of the obligor not paying back, their ability to honour their obligations. And other risks can include KYC and compliance risks and operational risk. So some of these are easier to mitigate than others. Things like compliance and operational risk is very process driven. You just need robust techniques to be able to be on top of them and identify any issues before they become a real issue. But then credit risk is the more obvious one, and there's a very established secondary market for trade finance risk. Typically that can be through channels of bank-to-bank participations. It can also be the use of insurance. So there's a very well-established insurance market for trade finance. There are other channels that are growing nowadays. We have more institutional investors who want to invest in trade finance assets. So developing the right techniques that can make that easy is quite important. And generally speaking, the last big one is obviously the more sort of syndicated loan approach, and also securitisations are useful for bigger transactions, but they also have their advantages and disadvantages. So the key is having a toolbox available to any originator of risk so that they can then use the most appropriate in any given situation.